Mike, let me start with you. We made it through the first half, pretty strong first half, a great June for the markets. Yeah. And the G20 gave them a lot of what they were looking for. So now what? Now we're getting a little bit of kind of headline cover for the move the market has made. I think the market was primed to just relax if we got an as-expected result, and that's what we're seeing right here. To me, it's about which groups take over. So is this going to be the handoff to more cyclical areas of the market? And, you know, we talk about what a great first half was. I'm looking at it on a 9-month basis. You go back to it, the market's basically flat at a nice marginal new high. So it makes it seem like the market's less ahead of itself if you say, hey, for 9 months we've been kind of, going back and forth toward this line. We're like 1%. The Dow's 1% from that high that it set back in October. Exactly. So that makes a lot of sense. I guess the question now is this going to be the signal that the market can just look through what still is, you know, kind of a slowdown story globally, and with earnings coming in maybe sloppy in the the second quarter? Jason, you say that there's something wrong with this rally. What's wrong?
Yeah, it was up until early last week, and you know, a lot of what's been said, you know, it was defensives that had led the move: utilities, consumer staples, and it was largely because the very front end of the Treasury market repriced 60 basis points in a short period of time. That helped boost the S&P, but more important, the rate-sensitive groups are what really ran, and like the utilities. So, you know, our point was that if the rally is going to continue, if the S&P is really going to break out of the range, it requires a rotation to cyclical type groups. And you hadn't seen that up until probably about early Tuesday, Wednesday of last week. Semis started to go because there's some individual company news. Even things like copper started to rally a little bit. We need to see more of that to get the S&P to continue to rally. Does that lessen your concern with that move starting? Yeah, that's right. Yeah. So, and you could see this is clearly a trade story. Those are the groups that are some of the most sensitive to the trade story. So basically, we need to repeat what we saw in the late fourth quarter and first quarter of this year, where it was semis starting to lead the market, copper really starting to move. All those things point to improving PMI. We basically have to redo that same story all over again here, to basically, put a solid foundation underneath the rally. With trade off the front burner for now, we've got the jobs report on Friday, which will tell us a little bit about the economy, and then people are going to start thinking, what about later this month? Is the Fed going to cut? It's interesting because the Fed did not take any opportunities to push back against the market's pricing of a cut for July. So at this point, I mean, obviously you have to see what the jobs number gives us. But right now the market's very confident it's going to get that. At least to 25 basis points. So that actually turns the question around to, wow, is this market going to get everything it needs and wants? And what does that mean in terms of a sentiment reset? Because I think people have been very cautious. Even as the S&P clicked to new highs, the sentiment numbers were showing a lot of caution because it just didn't feel right. And by the way, this goes back 3 years ago, almost to the day. The story was stocks are at a new high, and yet bond yields stay so low. The global economy is not showing us that we're coming back very much. 2016, the stock market was able to see through this kind of industrial lull. Now, we had a worse downturn in terms of the global economy than we have had so far right now. So maybe the market still is has to kind of endure a little more of that static in terms of bad growth numbers before we can get it all clear. Jason, let's talk more about the yields on the Treasury market. For a while on Friday, the 10-year fell below 2%, closed right at 2%. You say the technical level is 2.1%, and that's kind of a hard thing to imagine, that given where we are right now with the markets and everything else, with the equity markets, that we're looking at 2.1% as being a breakthrough level. That's right. Yeah, it's come a long way in a short period of time. So if we look at the technicals, you're seeing overbought conditions both in sentiment and momentum, multi-year overbought conditions. Now, that can persist if we really are in this rapidly evolving monetary policy condition here where the Fed's going to not only ease a couple times, but now you're starting to talk about recession and the Fed going to zero eventually. Those overbought conditions can persist. But anywhere outside of that world, you tend to get mean reversion. Even if we are in a bull market here, when you get the conditions you have now, you can see, our view right now is 10s can back up to 225, and this still could be a bull market for the bonds here.